In this week's video, we'll review the latest charts and data to help us answer the question: following a better-than-expected CPI report, are we looking at a false move or a sustained breakout? We'll be moving quickly, so feel free to use the pause button on your video player. The market has been fascinated with the topic of rate cuts. When are the rate cuts coming? And it's possible the more important topic speaks to, are they considering a rate hike? Because if the next move is a cut, that means the next move is favorable for markets. Tweet April 20th on your screen stated that the market odds anticipating a rate hike between April 20th and year-end was 0. The big news this week was we had the monthly CPI report. It came in below expectations and markets pushed higher. So we've just come off of a fairly significant pullback. The charts on your screen, we covered them in the April 26th video. This is the slide from that video. The takeaway on April 26th and in subsequent videos, because we've revisited these charts numerous times, was that all of this corrective activity up here, here, and here was occurring within the context of a longer-term bullish trend. SCHG, XLK, ITB, all of the charts in your screen, the corrective behavior on April 26th occurring well above an upward sloping 250-day moving average in black. And ultimately, you're playing probabilities. The look of these charts back on April 26th said the probabilities were favorable that eventually the market would go on to make a new high. We fast forward 3 weeks later to the present day. On May 17th, patience has been rewarded. Since the close on April 26th, SCHG up 4.5%, XLK 6.02%, VU up 4.17%, the triple Qs up 4.83%, ITB home builders up 2.9%, IWM small cap up 4.92%, and RSP, the equal weight S&P 500, up 3.47%. Since the S&P 500 peaked in March, we've covered secular volatility scores and trend strength scores. Slide on your screen is also from the April 26th video 3 weeks ago. Much like the charts on April 26th, the scores on April 26th said tried to be patient. Models have been helpful in recent weeks. The lowest secular volatility model score during the recent correction was 97, a very favorable 97. The trend strength portion of the CCM market model, the lowest score was 95 and change during the recent correction, a very favorable score. They all range between 0 and 100. And maybe more importantly, the long-term trend strength score never dropped below 100. And very, very similar to market expectations on April 20th, on May 17th, almost a month later, market pricing for a Fed rate hike. I want to emphasize we're talking about rate hikes here, not rate cuts. Market is placing a 0 probability on that outcome between now and December 31st. These are weekly charts on your screen dated May 17th. XLK, S&P 500, NASDAQ, and the Dow Jones Industrial Average, affectionately known as the Dow. All 4 of them made new weekly closing highs on May 17th, and you can see that on the weekly chart shown on your screen. And intra-week after CPI, they all made new daily closing highs, new 52-week highs. We won't make any assumptions going forward. We take it day by day. There wasn't much to be overly concerned about on April 26th. And since all of these charts have improved since April 26th, there's not a lot to be concerned about on May 17th either. We'll see how it unfolds, making no assumptions about what happens in the coming days, weeks, and months. Now let's flip over to some concepts that were helpful during the correction, helpful heading into CPI, and should continue to be helpful in the days, weeks, and months ahead. This chart of SPY is a weekly chart. It illustrates some concepts that I discussed with JC earlier in the week on his morning show. This chart is as of the close on Tuesday, May 14th, before the CPI report. And the basic message is we're in a bull market. This is a constructive looking chart from an intermediate to long-term perspective. Early in 2023, the slower moving averages in this region here, the 30-week in blue, the 40-week in green, and the 50-week in pink, came down near an upward sloping 200-week moving average in red. And we all know that secular bull markets tend to make us stand at or near an upward sloping 200-week moving average. And on this time frame, and again before CPI, we had a full bore bullish look with blue the fastest moving average on top and red the slowest moving average on the bottom. Price above all of the moving averages and all of the slopes are up. And the fact that we broke above the 2021-2022 high here, some markets peaked late in 2021, some peaked early in 2022, that tells us we most likely have a significant area of potential support below should the market choose to pull back. That's not a prediction in any shape, form, or fashion. It's just good to know. Very similar concepts. Weekly chart of XLK, arguably the most important sector in the stock market. Full bore bullish look above this base here. A nice strong trend look relative to the spacing between the moving averages and price, telling us that during this pullback here, from a probability perspective, it was most likely a 100% normal and to be expected pullback that occurs within even the context of the strongest trends. Very, very similar to the 10% correction back here in 2023. So we have a bull market, constructive, long-term look on the S&P 500 weekly chart. The same can be said for the most important sector, the tech sector. It's also relevant that the equally weighted S&P 500 index, SPY is a capitalization weighted index, which means the major stocks within the index, the mega caps, carry a heavier weighting. Not so in RSP or the equally weighted version. The exact same sectors, the exact same stocks, they're just weighted differently. This too is a constructive look. In fact, breaking above the 2022, late 2021 high, which is what we're doing in 2024 on the right side of the screen, the look of this chart is somewhat similar to the look of SPY or the S&P 500 in Q4 of last year when we broke above the same high. And we all know, walking forward from November or Q4 of last year, good things happen. This is a constructive, intermediate to longer term setup. It's also noteworthy that we have a very similar and constructive look as you would expect on the daily chart. We've got the 20-day moving average out to the 250-day moving average here. This is RSP as of a close on May 16th, knocking on the door of a new all-time and 52-week high, and the pullback held above the base. In the recent corrective activity in here, all of it occurred above an upward sloping 250-day moving average in black. The chart on your screen tells us that the concept that 7 stocks are the only stocks that are moving higher, that doesn't really make a lot of sense here. This is basically 500 stocks, multiple sectors, and the ETF is knocking on the door of a new all-time high. And if you think of it this way, on a relative basis, you almost have to flip that chart upside down. RSP, the equal weight S&P 500, relative to SPY, the standard capitalization weighted S&P 500, that ratio is knocking on the door of a new 52-week low, which means on a relative basis, RSP remains in a downtrend relative to SPY. So one of your weaker sisters, we own some RSP, one of the weaker sisters in our portfolio, in isolation looks quite good, and that says a lot about the stock market's risk-reward profile. If one of your weaker sisters looks this good, that tells us that based on what we know today, it's prudent to try to look at our current positions from a long-term perspective, and until something changes, for the most part, we should try to ignore day-to-day volatility. Very similar situation here. This is foreign stocks. This is Vanguard VEU, the All World Index, ex-United States, so foreign stocks. We also have some exposure in some of our portfolios to this ETF, very small amount of exposure. And it too is a weaker sister relative to the S&P 500. It's in a downtrend. The ratio of VEU relative to SPY is below a downward sloping 250-day moving average. So one of the weaker positions in our portfolio has a great and bullish setup currently. It's breaking above the high back here from 2021. All of the recent volatility in this region here occurred above an upward sloping 250-day moving average. We're very, very close to a full bore bullish look over here with price above all of the moving averages. Blue, the fastest moving average, is on top. Black, the slowest moving average, is on the bottom, and the slopes are all up. Contrast that with the look of price in the same moving averages in Q1 of 2022. And we all know that bad things happened walking forward from Q1 of 2022. All of this helps us assess the probability of good things happening relative to the probability of bad things happening, looking out several weeks and months. If the look of the charts change in a material manner, then we'll have to reassess those probabilities. So revisiting the weekly XLK chart, it's a healthy look. If we look at XLK relative to SPY, this is earlier in the week. XLK is outperforming SPY this week. This chart's dated May 14th, the day before CPI. This too looks like normal corrective activity within the context of an existing uptrend. The ratio of XLK to SPY came back to an upward sloping 200-week moving average shown in red in late 2022, early 2023, and found buying support. And like RSP in isolation, if this ratio comes back toward that upward sloping 200-week moving average, meaning XLK underperforms, there's a lot of potential support back in these regions here. Very, very similar situation if we look at the tech sector relative to the equal weight S&P 500. How does this help us? We're comparing a single sector to all of the S&P 500 sectors, and we're trying to remove capitalization-weighted type bias and look at the sectors on a more equally weighted footing. And this chart also, from a longer-term perspective, looks like normal corrective activity within the context of an existing uptrend. If the ratio comes back to this area here, we have potential support from this region, and this region here way back in 2020. XLK relative to RSP came back near that upward sloping 200-day moving average in red and made a stand. It's gone on to print a higher high above this high and a higher high above this high, telling us that the long-term bullish trend, the leadership trend for the tech sector relative to all S&P 500 sectors, as of mid-May 2024, that trend is still intact. Very similar situation if we look at semiconductors, SMH relative to SPY. This period in here, late 2021, look at the ratio of SMH to SPY in Q1 of 2022. When we get to this region out here, we have a full bore bearish look almost. The important thing is the ratio is below the moving averages. They're tight. We have a tight cluster telling us we may be getting a big move in either direction. And when those moving averages, the slopes start to roll over, tells us we may get a big move on a relative basis in a bearish manner. And that is what happened. Very, very similar to this look down here. The moving averages start to cluster together. We get that tight look. The slopes turn up. And since then, semiconductors have outperformed significantly. So this too, on a relative basis, the long-term bullish trend as of mid-May 2024 is intact. That doesn't mean SMH can't underperform and even underperform significantly for long periods of time. But until proven otherwise, that underperformance would be normal corrective activity within the context of a bullish trend. If you look at the moving averages in here in 2024, price relative to blue, green, pink, and red, it really doesn't look anything like this region in here. And if we move above point A, it looks a lot more like this region back here within the context of a bullish trend and a constructive environment. It's also interesting that the mega cap S&P 100 relative to the S&P 500 also has a constructive look, telling us that the mega caps, for the most part, still have a constructive trend relative to the 500 stocks in the S&P 500. Mid-May 2024, the weekly chart has a full-bore bullish look. It's quite a bit different than the look in here in 2022. This is Q1 2022. This is the bear market in here. The ratio of OEF, the S&P 100, relative to SPY, the S&P 500, broke above this peak here from 2020, came back and retested it during the correction in Q4 of 2023, and has gone on to print a higher high. And OEF is also tech heavy. The number one sector in the S&P 100, tech. Very similar situation if we look at the S&P 100 relative to RSP, the S&P 500 equal weighted index. OEF, roughly 36% exposure to tech. RSP, about a 15% exposure. There's a lot of indecisiveness in here, but for now, that breakout too is holding above this region back here from 2020. How about fear in the market before CPI, a report that many were concerned about? This is XLP, defensive consumer staples relative to SPY, or the S&P 500. It too is a weekly chart dated May 14th. We can look at this as a risk-off relative to risk-on ratio. This is what risk-off looks like, or increasing fear. This is January of 2022 here. You can see we go from a full-bore bearish look in Q4 of 2021 and quickly flip over to a full-bore bullish look favoring defensive and bearish-oriented staples. And when we say bearish-oriented, when XLP is outperforming strongly and for long periods of time, that speaks to increasing fear in the market. This is the spike in fear here during the COVID crash, and this is the move from early 2022 into late 2022 here. And you can see heading into CPI, we had a full-bore bearish look for the same ratio. The lower right-hand corner of your screen really didn't look anything like Q1 of 2022. Right now, defensive XLP relative to SPY is below a downward sloping 30-week, downward sloping 40-week, downward sloping 50-week, and below the all-important downward sloping 200-week, telling us this recent spike here so far looks like a counter-trend rally within the context of an existing downtrend. Nothing magical about this ratio. It's one component included in a weight of the evidence approach. This is IEF, 7 to 10 year treasuries relative to SPY. This is the spike in fear during the COVID crash here in 2020. This is where the S&P 500 bottoms at the COVID low here. So all things being equal, we'd prefer for this ratio to be below these moving averages relative to being above them. And that's exactly what we had down here heading into CPI on Wednesday. Ratio has a full-bore bearish look against IEF relative to SPY. And that tells us something that we've talked about in these videos for a long, long time. Most likely, inflation is not going away. We're going to talk about it for a long time. We've got deficits and very favorable demographics, creating a lot of demand. And the look of this ratio also tells us it's not likely that the Fed is going to cut interest rates 5 or 6 times anytime soon. And the look of this ratio also tells us that investors are concerned about the massive deficits that the U.S. government is running. All things being equal, they would prefer to own inflation protection-oriented stocks, or the S&P 500, relative to deflation-friendly 7 to 10 year treasuries. So the ratio is telling us market participants are not anticipating a financial crisis type deflationary event. Market participants are not anticipating a deflation-oriented dot-com bust-like bear market either. As always, all of the commentary in this week's video is based on the charts and data in front of us. We continue to grind away on the secular volatility research project. It's a very tedious but thus far productive process. All of these bullet points still apply, and we should keep in mind, most of the concepts and charts presented in this week's video speak to the longer-term outlook. They don't tell us what's going to happen in the first 3 hours of trading on Monday or over the next 3 days or even the next 3 weeks. They speak to longer-term probabilities. Probabilities that align with our longer-term investment objectives. Broad participation, sector rotation, all healthy. As we've illustrated, even your laggards, RSP, VEU, you can throw in IWM. They have constructive trends and/or constructive setups. That's a good sign. We don't want to get too cute in this environment with relative charts or being overly concerned about counter-trend moves. It's easy to get carried away with sector rotation. We don't want to trade our way into missing gains in an environment where the charts for stocks, for the most part, across the board, look favorable. If we get preoccupied with trying to be overweighted in the market leaders 100% of the time, that can be very, very harmful to our long-term performance. It's incredibly important that we make no assumptions about any topic on any time frame. And if we're going to do that effectively, it's important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.